Debt has shaped human civilization for thousands of years, and throughout all of recorded history, the same dangerous pattern has repeated itself over and over again with alarming consistency. Societies borrow money to fund growth and prosperity. The borrowed money creates the illusion of wealth and progress. People become confident and take on even more debt, and eventually the system collapses under the weight of what was borrowed. Long before we had modern banking systems or stock markets, ancient civilizations understood the power of borrowing, and many of them learned the hard way what happens when debt spirals completely out of control. The Egyptian dynasties borrowed heavily to build monuments and fund military campaigns. The Roman Empire took on massive debts to expand its borders and maintain its armies, and Chinese dynasties throughout history used credit systems to finance infrastructure and warfare. But each of these great powers eventually discovered that you cannot borrow your way to permanent prosperity. As we move through the medieval period into the Renaissance, we see kingdoms and city-states using debt instruments to finance trade, exploration, and art, and while some of these ventures created genuine wealth, others simply delayed the inevitable collapse by transferring the burden of repayment to future generations. Spain is a perfect example of this pattern because in the 16th and 17th centuries, Spain borrowed enormous sums of money to finance its wars in Europe and its colonial conquests in the Americas, and even though Spain was bringing back gold and silver from the New World, the government spent money faster than it came in. The debt accumulated year after year, and eventually Spain's fiscal crisis weakened the empire so severely that it could no longer maintain its dominance. France followed a similar path, and by the 18th century King Louis XVI inherited a kingdom that was already drowning in debt from previous wars and the extravagant spending of the royal court, and this debt crisis became so severe that it directly contributed to the French Revolution because common people were starving while the government collected taxes to pay interest on loans taken decades before. The modern era of debt-driven economics began with the development of complex banking systems and financial markets, and the transition from simple lending to sophisticated credit instruments that could be bought and sold changed the entire nature of how debt works in society. In the 19th century, the development of central banks, government bonds, and stock markets created new ways to borrow and lend on an enormous scale, and investors could now buy pieces of debt, which meant that the consequences of borrowing were distributed across many people rather than concentrated in one place. This might seem like it would make the system safer, but actually it made it much more dangerous because nobody could see the full picture of how much debt existed in the system or how connected all the different debts were to each other. The build-up to the Wall Street crash of 1929 perfectly illustrates how this works because in the 1920s, after World War I ended, America entered a period called the Roaring Twenties where everyone seemed to be getting rich and the stock market was climbing higher every single day. Investors believed that stock prices could only go up, so they borrowed huge amounts of money to buy stocks, a practice called buying on margin, which means they only paid a small percentage of the stock price upfront and borrowed the rest from brokers. Ordinary people, not just wealthy investors, were putting their life savings into stocks, and the optimism was so widespread that people believed a new era of permanent prosperity had arrived and that the old rules about debt and repayment no longer applied. But on October 24, 1929, the stock market started falling, and as prices dropped, investors panicked and started selling stocks as fast as they could. And brokers began making margin calls, which meant they demanded that investors pay back the money they had borrowed immediately. Suddenly, people who thought they were rich found out they were actually broke, and the selling pressure became so intense that the market crashed completely, wiping out fortunes in days and destroying people's confidence in the stock market forever. The Wall Street crash of 1929 triggered the Great Depression, which lasted for 10 years and caused unimaginable suffering because unemployment in America reached 25%. Families lost their homes because they couldn't pay mortgages, farmers lost their land, and people literally starved to death while governments struggled to figure out what to do. The cause of all this suffering was debt, because the stock market boom had been built on borrowed money, and when the borrowed money had to be repaid, the system collapsed like a house of cards. It was until governments started borrowing large amounts of money and spending it on public works projects and military buildup that the economy finally recovered. And this taught economists an important lesson: that you could fight a debt crisis with more debt, at least temporarily. The period after World War II saw the rise of new financial systems like the Bretton Woods system that tied currencies to gold and established rules for international trade, and for about 30 years the world experienced a period of relatively stable growth and rising living standards in developed countries. But this stability was built on cheap energy, moderate levels of debt, and a global trade system that favored the United States and Europe. And when these conditions changed in the 1970s because of oil price shocks, the economic consensus started to shift. The 1980s and 1990s saw a gradual transformation of how economies worked, with governments shifting from managing demand through spending to focusing on controlling inflation through interest rates, and financial markets were increasingly deregulated, which meant that banks and investment firms could take bigger risks and create more complex financial instruments. The 1980s also saw the belief that central banks had finally figured out how to manage the economy and prevent major recessions. And with this confidence came lower interest rates and easier lending, which encouraged both governments and individuals to take on more debt. Credit cards became widespread, adjustable rate mortgages were invented, and corporate debt increased dramatically, but the fundamental problem remained the same as it had always been: debt must eventually be repaid. During the 1990s and 2000s, the growth of financial engineering created increasingly complex debt instruments, and the most important of these was the mortgage-backed security, which bundled together hundreds or thousands of mortgages so that investors could buy a piece of the interest payments that homeowners made. The idea behind mortgage-backed securities was that by spreading the risk across many different mortgages and selling the securities to many different investors, you could reduce the risk for any one investor. But this logic had a fatal flaw. It created a situation where the people originating the mortgages no longer cared whether borrowers could actually repay the loans because the risk was immediately sold off to someone else. Banks started lending money to people with bad credit, people with no down payment, and people with adjustable rate mortgages that started with low interest rates but then adjusted upward after a few years, and all of these risky loans were bundled into mortgage-backed securities and sold to investors all over the world. Between 2000 and 2008, the amount of mortgage debt in America roughly doubled, and housing prices in many markets tripled or quadrupled, and millions of people borrowed enormous amounts of money to buy houses that they really couldn't afford. But in 2006 and 2007, housing prices stopped rising and started falling, and adjustable rate mortgages started adjusting upward, and suddenly millions of homeowners found themselves in a position where their house was worth less than what they owed on the mortgage. Defaults started accelerating, and as defaults increased, the mortgage-backed securities that were held by banks and investors all over the world suddenly became worthless because nobody knew which mortgages in the bundle would default. The major investment banks had enormous exposures to these mortgage-backed securities, and they had also used leverage, which means they had borrowed money to buy even more of these securities. So when the securities started losing value, the bank's capital was wiped out extremely quickly. In September 2008, Lehman Brothers, one of the largest investment banks in the world, went bankrupt, and the bankruptcy caused panic throughout the entire financial system because investors realized that if Lehman could fail, then any bank could fail. The interbank lending market essentially froze because banks were afraid to lend to each other, credit markets locked up, and the world seemed to be on the edge of a complete financial system collapse. Governments and central banks around the world responded with enormous interventions, including bank bailouts, emergency lending facilities, and massive reductions in interest rates. And these interventions prevented a complete collapse of the financial system, but they didn't solve the underlying problem of too much debt. Instead, governments borrowed even more money to bail out banks and stimulate their economies, which meant that the public debt of developed nations increased dramatically. The period after 2008 was characterized by extremely low interest rates and massive amounts of liquidity, and with interest rates so low, it became cheap to borrow money again, so governments, corporations, and individuals all started borrowing more. The European sovereign debt crisis occurred between 2010 and 2012 when investors started to doubt whether countries like Greece, Ireland, Portugal, and Spain could actually repay their debts because these countries had borrowed heavily during the boom years and then faced plummeting tax revenues when the recession hit. Greece had actually been lying about its debt levels, and when the true numbers were revealed, investors panicked and demanded much higher interest rates to buy Greek government bonds, which meant the government had to pay more money to borrow, making the debt crisis even worse. The solution imposed by other European countries was austerity, which meant cutting government spending and raising taxes. And this policy had devastating consequences for ordinary people because, while it supposedly helped restore investor confidence, it actually made the economy worse by reducing demand and pushing the country into depression. Greece's unemployment rate exceeded 25%, youth unemployment exceeded 50%, pensions were cut and taxes were raised. And the people who lost jobs were not the wealthy people who had borrowed the money or made bad investments, but ordinary working people who had no control over the fiscal policies. The debt crisis in Europe showed that the solution to debt is not more debt, and that cutting spending during a recession is a recipe for depression and social collapse. But wealthy governments like the United States, Britain, and Germany, which could borrow at low interest rates, were able to recover more quickly because they didn't have to impose the same kind of strict austerity measures. The years after the financial crisis saw continued growth in debt because interest rates stayed low, and central banks kept pumping money into the system, and corporations used cheap debt to buy back their own stock, which boosted stock prices but didn't actually invest in new factories or research that would create real economic growth. Governments in developed countries ran large budget deficits, meaning they spent more money than they collected in taxes, and these deficits were financed by borrowing. By 2020, the levels of government debt, corporate debt, and household debt in developed countries had reached record levels, and then the COVID-19 pandemic hit, and governments responded by shutting down their economies and spending trillions of dollars on relief programs, which caused debt levels to increase even more. After the pandemic, inflation started rising, and central banks started raising interest rates in an attempt to control inflation. And higher interest rates meant that governments had to pay more money on their debt, and corporations struggled to refinance debt that had been taken at lower rates. The pattern that has repeated throughout history is now playing out again at an even larger scale. And it is clear that the fundamental rules of debt haven't changed. When people and governments borrow more money than they can reasonably repay, when that borrowed money is used to inflate asset prices rather than create real productivity and growth, and when the entire system becomes dependent on continuous borrowing to function, then eventually something breaks. The question that nobody can answer with certainty is what will break and when it will break, because the timing of a debt crisis is impossible to predict. But what we can say based on history is that debt crises are inevitable if the underlying problem is never fixed. Some people argue that this time really is different, that modern governments with their own central banks can control the process and prevent a major collapse. But these arguments are the same arguments that people made before 1929 and before 2008. The hard truth is that debt is just spending brought forward from the future. And if you spend more than you produce, eventually, you have to pay the bill, and the longer you put off paying the bill, the bigger it becomes. Debt feels like growth, but it's actually just an illusion of growth, and once people realize the growth was illusory, confidence collapses and the entire system unravels with terrifying speed. History shows us that the pattern is always the same. Cheap credit flows into the system, asset prices rise, people become confident and borrow more. The debt grows faster than the ability to repay. A trigger event exposes the weakness, panic spreads, credit dries up, and the economy contracts sharply. The wealthy often protect themselves by reducing their risk exposure early, but the middle class and the poor bear most of the burden of the crisis, and this inequality tends to worsen after each crisis. The real question facing modern economies is not whether another debt crisis will occur, because the historical pattern strongly suggests that one will, but rather what can be done to prevent it from being as severe as it might otherwise be, and how we can make sure that the burden is shared more fairly rather than falling almost entirely on ordinary people.